Welcome to Money Matters. I'm DCrowell from Mortgage Network, and I'm here to solo today to give the presentation of the state of affairs in financial markets, the state of affairs in the national economy, the state of affairs in the world economy, and how that all relates back, hopefully, to Beaufort County. So we have a huge scope of relevance here, and a huge task, which is to reduce all of these amazing things that are going on in the world back to Beaufort County and Money Matters. My cohort, Emily Johnson from Polaris Capital, is on holiday, and she'll be back starting next Friday. So today is Friday the 5th, I believe, of January, the first show of the new year. And in this first segment, we have two segments. In this first segment, I'm going to sort of give you a snapshot of where things are in the markets. And then in the second segment, I'm going to give a positive forecast for 2018 and a negative forecast for 2018. In other words, I'm going to take the bullish and the contrarian view just so you can see what's out there. So where are things today? We come into the new year with the stock market yesterday having hit an all-time high. It broke through the 25,000 level for the Dow, and that's pretty amazing. 25,000 is the longest bull run now recorded, and yesterday when it hit 25,000, it was the quickest and shortest period of time that it has ever taken the Dow to rise 1,000 points. So the Dow's move from 24,000 to 25,000 was in the shortest time ever. So that's the Dow. The Dow is heavily composed of big investors and heavy-duty traders. It's generally considered that the S&P is a slightly better indicator of the true state of the economy. The Dow does not indicate the true state of the growth in the economy, nor does it necessarily indicate continuation of earnings. The Dow is not in itself a forecaster. Very, very important point. The Dow is the Dow, and the stock market is the stock market. Stock market does not forecast or necessarily reflect current or future performance. It reflects trading positions and availability of capital and a variety of other needs, wants, and expectations, such as the necessity of yield, the necessity of specific investment returns, which are reflective of the investor's unique and circumstantial position. So Dow is in a crescendo. Interest rates are going up. Finally, the Fed funds rate, the rate that is set by the Federal Reserve, the rate at which banks can borrow money from the so-called Fed window, the rate at which banks borrow money from the Federal Reserve, is trading between 1.4% and 1.5%. 1.4 and 1.5%. Trades right in the Fed window, is right in that range. That's the rate at which banks can borrow. Remember from previous sessions in which I've spoken, a major bank has a cost structure and a business model which necessitates approximately 3% in order to run the bank, in order to run the bank and make a profit. The bank must earn 3% on borrowed funds. So if the bank is borrowing at 1.4% or 1.5% from the Fed window, and it must charge 3% in order to be a business, then the rate on the street from the banks is 4.5%. And guess what? The prime rate of interest went up a week ago to 4.5%. So my old equation has held steady. Just take the Fed funds rate. You can look it up in the Wall Street Journal. You can look it up and Google it, Fed funds rate, and see where it's trading. Add 3%, and that's the base lending rate for the banks. For mortgages, remember, the bank lending rate is the short-term bank lending rate. That's what your equity line of credit is going to cost you. That's the prime rate. That's what your short-term borrowing is going to cost. Long-term borrowing typically costs more. However, we have, for the first time in a very, very long time, a slightly inverted yield curve. So the 10-year Treasury is flirting with 2.4, 2.5%. 10-year Treasury, that's a yield. The Fannie Mae securities, which are 30-year mortgage securities, selling for around 3.67, 3.68. Freddie Mac securities selling for about the same. Mortgage rates on the street, 3.99 as of yesterday, 3.99. So 30-year fixed rates. So if an equity line of credit in your local bank is 4.5%, and across the parking lot, a mortgage network can lend you a fixed rate of interest for 30 years for 3.99%, that's the definition of an inverted yield curve. Short-term money more expensive than long-term money. 99% of the time, the yield curve is a positive yield curve, not a negative yield curve, a positive yield curve where the short-term money is less expensive, the long-term money more expensive. But right now, we're looking like this. The pressure seems to be on for mortgage rates to rise. Why is that? Well, in the second section where I do a forecast for 2018 of all kinds of positive news and positive projections, and then contrast that with the negative possibilities. I'm going to give you the plus and the minus. I'll talk more about that. The thing to watch for, if you're sitting at home and looking at all the numbers and you're following your stocks and you're following lots of indicators that you already have taken an interest in, the thing that's really interesting to look at is the little summary. If you pick up the Wall Street Journal once in a while, look at the summary in the business and finance section of daily rates, because it's a nice little synopsis. What's the CPI? What's the inflation index? What's the federal funds rate? What's the 10-year Treasury selling at? What's Freddie Mac selling its mortgage securities at? I mean, this is all in just a tiny little section in the finance section of the Wall Street Journal, and it gives you a lovely summary of what's really going on. As of this instant, from November of 16 to October of 17, inflation actually went down by 0.17%. So it's extraordinarily low inflation leading into today, January 5th, 2018. We've got a backdrop of extraordinarily low inflation. the Federal Reserve has already got its antenna up, and 3 times they're expecting to increase rates 3 or 4 times in 2018 because they think inflation is coming. So that's it for the first half of the show. Please stick around for the second half of the show. Thank you.